The mark of a great options trader is that he's constantly seeking new, effective trading ideas to widen his base of trading plays and diversify the portfolio of trades that he uses to allocate the capital that we entrust to him. I'm the head trader of SMB Capital's options trading desk here in New York City, and today I'm going to share with you a simple to understand strategy to take advantage of the unique characteristics of options as they approach earnings. This was based on an idea developed by one of the traders on our trading desk, a simple 3 to 7 day trade that has significant potential, and the principles are pretty easy to understand, so stick around. I think you're going to find this interesting. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. So I'd suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really quite valuable. Okay, so let's jump into the guts of the lesson today. As you're probably aware, public companies are required to report earnings every 90 days or so, covering each quarter of their fiscal year. You probably also know right after earnings are released that stocks typically make a large move of some sort, either up or down. It's an outsized move compared to its typical day because the earnings release provides investors with a fresh view of the company and its future prospects. Well, the options market takes notice of this, and so options traders and market makers tend to bid up the price that traders pay for options as they approach earnings. So you might ask why that is, and the answer is that the seller of that option, whether he's a market maker or an independent trader, by selling you that option is taking the risk that the option he's selling you will be triggered, in which case he'll lose money unless he has built enough profit into that option that even if it gets triggered, he can still make a profit from having sold you that option. And that risk gets way bigger as earnings approach. So let's take a look at an example of this phenomenon. Apple announced that it was going to release its earnings report on April 30th. Now, to show you how pumped up the options get prior to earnings, let's go back to April 12th. You can see that Apple was trading at $199.70 on that day, so just a few pennies away from 200. The 200 call, as you can see, was going for $2.17. So if you bought that call, it would entitle you to buy 100 shares of Apple stock for $200 at any time in the next 6 days when the option would expire, regardless of how high the stock got. So the seller of that call is required to sell you those shares at $200, regardless of how high the shares go. So he loaded $2.17 into his call price to cover the risk of Apple over the next 6 days, shooting way over 200. So if you think about it, the call seller's break even is $202.17. Why? Because if Apple closes at $202.17 on the day the option expires, then the seller will have to sell his shares, which are worth $202.17, for $200, but he's received $2.17 for the call, so at $202.17 exactly, he's broken even. But at $205, for example, he'd have to deliver shares worth $205 for $200, and so his call price of $2.17 per share did not offset the loss he's taking per share, so he'd lose $2.83 per share for having sold that call. And so, with 6 days to go, the call seller calculated that he wanted $2.17 for that risk. Now, let's move to about 5 hours before Apple releases its earnings report on April 30th. It so happens that Apple was trading almost exactly at the same price, this time $199.69, and you'll see that an option expiring 4 days later carries a price of $5.10. That's about 135% higher than the $2.17 price from just a few weeks earlier when earnings were not imminent and therefore not heavily driving the price of the option. Now, why would that option's price 4 days later be so pumped up? And that's because the option will be alive during earnings, which is just 5 hours away. And so the market is really concerned about a big move based on the earnings release, and thus it's loading much more premium into the call price to cover that potential. So now how can we take advantage of this increased fear of a big move as the stock is approaching its earnings release by using options strategically? Well, we're going to take a look at an example of that in a minute, but before we jump into that, I did want to mention that we are currently running a 2-hour free intensive workshop where we'll be teaching you 3 additional real-world option strategies that our traders use beyond the one I'm teaching you in this video today. The strategies we'll be teaching include a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. So just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so back to the earnings trade we were talking about. Let's turn back to April 22nd when Apple was trading at $203.70 to see a really good example of this phenomenon. And by the way, if you stick around and watch the whole video, I'm going to show you a way that you can develop your own ideas for this kind of trade in the future on stocks that you like to trade. So anyway, now Apple was planning to release its earnings report after the market closes on April 30th, 2019. So this trade is initiated 8 days before that on April 22nd. So what we could have done on that day is to sell on the April 26th options chain, which is before earnings will be released, 10 of the 202.50 call options. We'd receive $2.83 for those options and then move over to the first options chain, which expires after earnings, which is the May 3rd options chain, and buy 10 of the 202.50 call options, costing us $5.92. So we've just bought what is known to options traders as a calendar spread, where we are short one strike in an earlier options chain and long that same strike in a later options chain. But this calendar spread was strategically placed so that the short call option that we sold expire before earnings and the long options we bought expire after earnings. So as you can see, the 10 May 3rd calls that we bought are costing us $5.92 per share, and each option contract represents 100 shares, so the cost of 10 of them is $5,920. With the same logic, the amount we'd receive in cash in our account for selling the 10 April 26 options is $2,830, which nets our cost down to $3,090. So that's the capital we're putting into this trade. Now, let's see what happened 4 days later, which is less than 2 market days from when earnings will be released. Now, as it happens, Apple was trading at almost exactly the same price 4 days later, 2:30 in the afternoon. Now, I picked that exact price point intentionally so that you can see apples for apples, the same price 4 days later. Let's really drill down and see what has happened here and why. Now, look at how the short options have shrunk down in value to $1.24. That's 64% reduction in their value. Well, we sold those for $2.83. So when you're short an option and it goes down, that's a good thing because then we can rebuy it and close the transaction on that option for a profit. Now move over to the 10 long call options and you're going to see that those are now trading at $5.45, which is less than we bought them for, no doubt, 8% less, but still less. So we're actually down money on those options. We're down a little bit on them. So you may be asking, why did the short options shrink much more in value than the long options? And so one answer to this is actually true when you're talking about any calendar spread, not just one traded near earnings. And that is that the options that are closer to expiring are losing value faster than the options expiring later than the short options. Why? Because the market simply has less time to make the big move that would give the option a lot of value for the ones closer to expiring than the ones farther from expiration. That's actually the basic reason that a calendar spread works at all. Calendar spreads take advantage of the relative drop in the value of near-dated options compared to the farther dated options. However, there's a second really important reason that the short options shrunk so much more than the farther dated options, and that's because the short ones expire before earnings, so they're not pumped up by the imminent earnings releases we were talking about before. But the farther dated options are expiring after earnings, so they are going to remain pumped up until the earnings are announced. Now, they will lose a little value because time's passing, but they will retain most of their value because the option sellers have to be aware of the potential large move that could take place after earnings are released and charge enough for that eventuality to make the reward of selling them worth the much larger than normal risk. So now let's calculate what all this means in terms of trading profits. So if we went ahead and closed the trade, what would we do? We'd sell off the long calls, and as you can see from the calculation, we'll receive back $5,450 from those, which is less than we paid for them, but not a great deal less. But to buy back our short positions in the April 26 calls, we only have to pay $1,240, which is way less than we were paid for them originally, if you remember. So the total proceeds from closing the trade is $4,210. So let's look at the final profit calculation. And as you can see, the proceeds we received back for closing the whole trade is $1,120 more than the original cost of the trade. And so that's our profit, $1,120, which is a return of 36%. And that all happened in 4 days. So the key takeaway from this video is that options afford you some opportunities that no other trading asset can. And that's because the value of options fluctuate in ways that are predictable, although you need to study and understand them to take advantage of those special properties, like the opportunity we laid out for you in this video. This is the way options professionals trade because they've worked at the craft of options trading. They are constantly seeking new ways of looking at the markets and how to take advantage of repetitive circumstances like earnings releases and then exploiting those opportunities through options concepts that they've internalized. Those are the kinds of guys we love to hire for our trade desk here at SMB. Just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now it's your turn. I'm guessing that there are a lot of you out there who like to day or swing trade certain stocks. Well, this strategy that we just went over works best on stocks which tend to settle in and around a certain price right before earnings, like in this example where the stock passed through the same price 4 days later, right before earnings, which is a really good setup for this kind of options trade. So what I'd like you to do is to study the price charts for stocks that you like to trade and comment below with which stock you think might be a good candidate for this kind of earnings trade in the future, the kind of stock which tends to stay in a fairly tight range right before earnings. Let me know the ticker symbol of that stock, and we'll try to do another video in the future where we'll use this technique on one of the stocks that you guys recommend and see how the trade would have come out. I think that'll be fun, and we can all learn something about how calendar spreads can work around earnings.